The stock market is wild in October, there's no doubt. It's not just the US, it's all over the world. Bank stocks are in a bear market, and based on what we saw a decade ago, that could easily become a protracted recession. The financial system is incredibly weak, and with stimulus being reduced, where will the stock market be at in 2019? You came here for the truth, so let me unveil that for you. Today we're going to look at what is happening with the bank stocks. I want to show you the stock market and what it's doing. Interest rates are a huge factor. I've got a lot to cover today, many different topics. Let's begin by taking a look at this very important and critical factor. Deutsche Bank seeks to break vicious circle as growth eludes. This article comes out of Bloomberg, and you can see that Deutsche Bank is a company that is massive by so many measures. We're looking at a company that holds a derivative exposure that is basically as big as all of the economies of the world put together. It is massive. It is beyond massive. After multiple turnaround plans and promises to restore growth, Deutsche Bank investors are no longer buying the talk. And I've been talking about this stock for a while. I've been suggesting to everybody to keep their eyes on it and watch what happens. And it keeps getting worse and worse and worse. The German lender, already the worst performing major bank stock in Europe this year, closed at a record low on Wednesday. There you go. Now, they're trying to change who's in the management. They're trying to be able to stimulate this stock. They're trying to make this completely decaying carcass alive once again, but you can't do that. This is one of the global systemically important banks, also known as the too big to fail, and I would like to refer to them as the zombie banks because they're all insolvent, and yet we see them doing business. We see their stock on the stock market, and there's no possible way that this could ever go bankrupt because it's too big to fail. Well, what's happening today should be a reason to believe that failures are allowed to exist, but perhaps not forever. And what we can see what they're doing now is suggesting maybe there will be a merger before the next crisis hits. Maybe I would also suggest that we could see a nationalization of this company. I don't know what's going to happen. I don't know how they're going to get bailed out, but eventually when all the investors are gone, the ECB or Germany is going to have to buy up all of their debt. They're going to have to buy up their shares perhaps. Who knows what's going to happen to this? But eventually this is going to go from bad to worse. I'm going to show you the stock in just a second here. Shares closed at a record low after weak results. Come on. This is not just about weak results. This is about a failure. And you could see all throughout 2018, from this point on, it has been nothing but down, down, and down. We are now under €9, closing at a record. It is truly something that I have been talking about for a while, simply because we're looking at the importance. We're looking at the derivatives, and I like to always look at what has happened previously to think what could happen tomorrow. And that is, we could see another crisis, and in that crisis there will be opportunities, and through that there could be some sort of expansion of these multinational conglomerates. There could be a reason to make this big bank even bigger, to put all of their debt onto the backs of the taxpayers. And they do so always in a crisis. They can't do it when everything is fine. They have to wait for a critical moment, and then the government rushes in and they say, we know exactly what to do. They enact something immediately, everybody signs it, they don't read it, and there you go, problem solved. However, in doing so, they usually lack any sort of transparency. There's always more control by fewer hands, and people end up losing out. But that would be some deja vu, right? Yeah. And you could look here at the 1 month chart, the 6 month chart, the year to date, the 1 year, the 5 year, no matter where you look, it's bad. It's bad. All the while, the stock market had been rising this whole time. Sure, maybe 2018 is an exception, but look at this. The entire time, stock market's going up in many countries, and yet this stock that's so important, and yet it's failing. If this was any other company, if this was any normal corporation, a non-financial, non-global systemically important bank, this would have probably already declared bankruptcy. But the way it works is that they keep it alive. It's a zombie. It's insolvent. Let's just call it for what it is. This is directly out of the ECB's own website. Remember, here at the Money GPS, you always get the source of the information directly from there. I don't like to mince words. I bring it right to you. Based on our regular economic and monetary analysis, we decided to keep the key ECB interest rates unchanged. Of course, they cannot increase them. If anything, they're going to decrease them. We continue to expect them to remain at their present levels at least through the summer of 2019, and in any case for as long as necessary to ensure the continued sustained convergence of inflation to levels that are below but close to 2% over the medium term. So they're going to try to keep inflation at 2%. They're going to continue these rates at least summer of 2019. But something did change, and that's right in here. Regarding non-standard monetary policy measures, we will continue to make net purchases under the APP, that's the Asset Purchase Program, at the new monthly pace of 15 billion euro until the end of December 2018. There is a policy that's going on globally today, and it is called QT, quantitative tightening. All the garbage that they've been printing up, well, they're slowing down. So if you look at the central bank balance sheets, they had been escalating over the years, particularly since the financial crisis. But now they started to bring that down. And it is a measurable amount at this point. I believe it's close to $1 trillion worth. But we see this taking place, and they could easily just turn it around. There's no doubt about that. They could stop their money printing. They could really slow down as much as they desire. But it is happening. At least as of this moment, it's happening. That's what they're telling us. Behind the scenes, I don't know what's happening. I'm bringing you the facts directly from them. But what we can tell based on the trajectory is that over time, slowly but surely, this quantitative tightening policy is continuing, and that will have a direct and correlated impact on the stock markets. If they continue, we will definitely, absolutely see stocks come down. If they decide to reverse the policy and bring the let's say all of the purchases back up, they reduce interest rates and so on, sure, stocks can go up. But not when they're using their quantitative tightening policy. That's just a fact. That's using history to prove a point. Now we got somebody, you know him, Jim Cramer. Now I don't blame Jim Cramer himself. He's an employee here. He's just doing his job. He's reading from the teleprompter. In this article, he talks about why people should not be panicking today, why they should be using any sort of dip in the market as an opportunity to buy more. And what I have to talk about is the concept of incentives. This program, okay, whether the individual, whether the corporation, they're paid by advertisers. These advertisers sell you different funds. They sell you insurance. They sell you financial products. And do you think for a second that they're going to advertise on a program that's telling you to sell, that's telling you to buy, physical gold, that's telling you to buy real estate, that's telling you to buy farmland, that's telling you to put your money, take it out of the system and invest in some real assets? Of course not. Of course not. But people don't see that. They don't see that. Because in a bull market, everything is fine. I'll tell you that again. When you look at a bull market, everything is fantastic. In a bear market, suddenly people are throwing eggs at Jim Cramer. Suddenly people are hounding this guy down saying, why'd you tell me to buy Bear Stearns? But he's just one example. We got to stop focusing on the individual and understand the concept of incentives is very important. One of my favorite books on this topic is called Freakonomics. It's a very easy read. You should probably read it if you haven't already. There's probably even some information on it. You could probably find some videos about it or something if you haven't seen it. But Freakonomics, it's largely about incentives as well as some other factors. But definitely check that out. Now, this right here is directly from the ECB as well. And I just wanted to show you the difference between a country like Germany and a country like Italy and Spain. And you'll see that this is the target balances, by the way, which is essentially where the money is at. Italy and Spain are heavily underwater today. And they do so with constant and never-ending worsening conditions, particularly Italy. There's huge deficits. There's huge debt. The debt to GDP ratios are off the charts. Look at Greece. Look at all of these different countries. And they suffer because you're trying to keep one interest rate, one group, one body, one supranational entity over so many others. Who are they going to favor? Well, I'll tell you right now, they're not going to favor you, no matter where that is. They're going to do what they need to do to make sure that this whole scheme keeps going. They don't want to make things realistic. They don't want to make sure that the whole system is working efficiently. All they want to do is protect their friends. Foreign buying of U.S. Treasury softens, unsettling financial markets. I showed you the actual statistics. If you type into a search engine major foreign Treasury holders, you get them. It comes up, and I showed you that they're selling right now. Who's going to buy? I covered that in the other video. You have to look at it for yourself. Just wanted to show you that even the Wall Street Journal, a little delayed, mind you, are covering it as well. Banks' golden deposits are heading out the door. There's something that's very interesting about banks is that you give them $1, they can loan out 10. If the economy is doing really well, then they can actually loan out up to, as far as I'm aware, $33. Okay, so $1 in, $33 out. It's ridiculous. Fractional reserve banking should be abolished, but here we are today. There's less free money to go around for the banks. After 3 years of rate increases from the Fed, customers are pulling billions of dollars out of accounts that don't earn interest and putting them into higher yielding alternatives that will crimp banks' ability to grow profits going forward. So what they are doing is they're taking their money out. Why? Simply because it's not returning any profit for them. Okay, you get to put your money in the savings account. You get a few pennies at the end of the month if you're lucky. All of these pennies don't add up to anything. But what they do add up is for keeping the banks, when they have to give you nothing and they're able to make money on their deposits, that there is so good. It's so easy. The risk is extremely low and they don't have to worry about it using this concept of fractional reserve banking. It's fantastic for them. However, people are getting a little bit fed up. They're pulling their money out and they're putting them into higher risk things. They're putting them into stocks. They're putting them into their 401ks, and that here is not a good thing. Auto dealers see slowing sales, sparking fears that the long-expected decline is here. The Cash for Clunkers program, you know that interest rates are increasing. People are taking 8 years to pay back their cars. What else can I say about this? The slowdown is definitely coming. Quants now trade exotic stuff, but can they handle illiquid? The search for elusive alpha is sending a handful of computer-driven hedge funds trawling for the remotest corners of financial markets. We know that this is the end. This is where it gets very, very desperate, when they'll trade any garbage to get some yield, to get some money, right? Now a few are seeking uncorrelated returns and a little extra alpha in anything from cheese and Turkish scrap steel to obscure chemicals or eggs in China. Hey, do you have any blue cheese? Do you have any Gouda? Do you have any Parmigiano? I'd like to buy some for it from you, and this is just... what am I reading? Is this Enron? Are we back into the insanity days? Why are these markets to be trading on by computer algorithms? Come on, everybody. Anyway, and this is just this is the beige book. Beige book is from the Federal Reserve. I've brought it to you many times before. In this beige book, it's hilarious. You have to see this. Okay. So the beige book basically just goes through all the different Fed banks, and they report on what they think. Okay, and usually they're approximately the same. But I searched the word tariff, and look at this result. One, you might not be able to see that the font is pretty small. The word tariff comes up 51 times in this one report. Do you want to guess what they're concerned about? That's right. If you found this video informative, please give me a thumbs up. When you give me a thumbs up, you're supporting this channel. That's all you got to do. Click that button. If you want to join over 150,000 subscribers, click that subscribe button and join me as we head towards 151,000 subscribers. That's right. You can be one of those. Click that button. 151,000 subscribers. Let's do it. I'd like to see you there. Now, if you want the financial education you were not taught in school, well, then these two books have it all. You can get all the information you need to know from A to Z, the foundation, the asset classes, how to make money, what to do with your money, what to ask your financial advisor. Check it out. Link in the description below. If you're more interested in the audiobook version, you can get that at themoneygps.com.